Welcome, everyone, and thank you for joining us today for our session on Payday Super. My name is Ali Suleyman, and I'm a partner in our tax advisory team at Pitcher Partners, Melbourne. As we gather for this virtual event and are physically dispersed, let's recognise the various traditional lands on which we do our business today. I wish to acknowledge the traditional custodians of the land we work and live on and pay respect to the past, present, and emerging generations. As I just alluded to, last month, legislation was passed confirming that employers will essentially need to make superannuation payments at the same time as they make salary and wage payments, hence the name Payday Super. Presenting alongside me here today will be client directors Elena Bogomolova and Nigel Glasspool. Elena has been a part of our tax advisory team at Pitcher Partners now for over 10 years and has extensive experience in all of the relevant employment taxes, from superannuation to PAYG withholding, payroll tax matters, FBT, amongst other employment tax issues. And previous to her time at Pitchers, she has experience within the SRO and at a large professional services firm. Nigel is also a client director at Pitcher Partners Melbourne in the digital and data practice with deep domain experience in assessing, procuring and implementing human resources information systems, workforce management and payroll cloud solutions, and workforce management and payroll cloud solutions. He has worked with many of our clients on all aspects of pay compliance, including several rectification and remediation projects. So we are fortunate to have Nigel with us today. In today's session, we'll also be joined by Peejade, Cheng and Gary Matthews, who will be assisting in answering your questions, some of which we've received ahead of the session and hopefully some that we'll receive throughout the session. Peejade and Gary are both senior practitioners within our practice who both have extensive experience across all forms of employment taxes similar to Elena. Both have had experience not only at Pitcher Partners but also within industry and other big accounting firms in Melbourne. Hopefully, as part of this invitation, you've already had the opportunity to read our latest employment taxes update, just to stay across some key developments impacting employers, including the introduction of Payday Super. However, if you haven't, it is available on our website, www.pitcher.com.au, or if it's easier, reach out to your usual PP contacts and we'll be able to direct you accordingly. So just to provide some context for the changes. The changes have been introduced to create a strong incentive for employers to make superannuation contributions for their employees at the same time as they pay the employees' qualifying earnings. And Elena will go into this in a little bit more detail shortly. In the explanatory memorandum that introduced the changes, it is rationalised that the increased frequency for making superannuation guarantee contributions compared to the previous quarterly superannuation guarantee model will enable unpaid or underpaid super guarantee to be detected and managed at an earlier stage. The measure is intended to address unpaid superannuation, which totalled nearly $5.2 billion during the 2022 year alone. The changes are expected to particularly benefit those in lower paid, casual and insecure work who are more likely to miss out when super is paid less frequently. Women are often overrepresented in this group. Now, according to the ATO, approximately 40% of employers already pay more frequently than the quarterly requirement for superannuation. So I presume the ATO believe the changes may not be as impactful for all businesses as what we might all be expecting. I suspect the ATO really are underestimating the impact of the changes. Now, the changes apply to all employers and employees in all industries and can apply to directors and contractors too. It's not something that businesses can opt in or out of, and the size of the business does not change the fact that superannuation payments need to align with the salary and wage payment cycle. In May 2023, when the changes to Payday Super were first announced, the government stated that more resources would be available to the ATO to help it detect unpaid super payments earlier, and the government will now set enhanced targets for the ATO in terms of the recovery of payments. Reflecting this increased resourcing, the ATO have already started to get the messaging out on Payday Super and have updated their websites and provided some instructional videos online too. So what will today's session provide? What we hope to provide you in today's session is an understanding of the changes and an awareness of what may be required for your business to allow you sufficient time to plan for the changes. It is not something that can be addressed easily and at the last minute, so I do encourage you to start thinking about how the change may impact your business. It will also allow you to identify the areas where you may need to seek external support to help implement the changes. So in terms of the agenda today, what we will cover include the following: what Payday Super means and how the super guarantee charge will be affected by the changes, the impact of the changes on the single touch payroll system. Then we'll move over and Nigel will cover system and processing changes for us. And along the way, we'll provide some tips on what to start doing now. At the end of the session, we have left some time and we'll get our presenters together, particularly with Gary and Peejade, and we'll have some time for questions and answers and hope to have about 10 minutes allocated for that at the end of the session. So with that, we'll now move on to the Payday Super changes in more detail with Elena.
Thank you, Ali, and hello everyone, and thank you once again for joining our webinar. I hope you will find it useful. So let's get started. From 1st of July 2026, employers will be required to make superannuation guarantee contributions at the same time as they pay employees' earnings. These contributions will need to be received by the employees' super funds within 7 business days of payment of qualifying earnings. I will discuss the concept of qualifying earnings shortly. This is a new term, and it also referred to as payday payment. So the payment of super will be required after every payday. So if the business is using a pay cycle of weekly, fortnightly, or monthly, this is need to be aligned with payment of super. The aim of this reform is to reduce unpaid superannuation guarantee contributions and improve transparency. It is important to point out that the employer will have 7 business days, not just to make a payment, but within 7 business days, typically 3 things will need to happen. First, payment has to be made by the employer into the clearinghouse. Second, be processed by clearinghouse. And third, be able to be allocated by the employee's super fund into the employee's super account. So from the business perspective, the best practice would be to make super payments on the same day as payment of qualifying earnings to maximize the chances of them making into super fund on time. If the payment is not able to be allocated due to being incomplete or inaccurate and is rejected and returned to the employer, it is likely to be late when it is resubmitted for processing. Nigel will discuss various system changes and improvements to reduce number of these instances in his part of the presentation shortly. There are some exceptions. One exception from the 7 business day requirement is when business has new employees or when existing employee provides a new choice form because they have changed their super fund. In these circumstances, the employer is going to be contributing for the first time into the fund. The business will have up to 20 business days to make super payment. 20 business days also is expected to be available in cases of exceptional circumstances, such as natural disasters, but this is still subject to a commissioner's determination. Other exceptions include out-of-cycle payments, such as bonuses, commissions, or back pay, that are processed outside of normal pay cycle. Super in respect of this payment can be paid within the next regular payday rather than immediately. If you look at the diagram on the slide, we have assumed a monthly pay cycle there. In case of a weekly or fortnightly cycle, the next QE day or payday may come earlier than 20 business days. On the next slide, we have put together some new terms. This is just a glossary for your reference. I'm not proposing to go through this slide in details, but thought it could be useful as we will refer to these terms throughout the webinar. Now let's look into the concept of qualifying earnings. This is a new term and it represents a contribution base on which super payment will be calculated. It will effectively expand the current term ordinary time earnings and include other currently superable items which are located in different parts of the legislation. So qualifying earnings will mean what is currently understood as ordinary time earnings. It will also include all commissions paid to an employee due to overtime hours or otherwise. This concept is new. Additionally, it will include amounts of employees' salary sacrifice for super, but not to fringe benefits. This is not a different concept, and this is how the rules currently operate. It will also include earnings paid to workers who fall under the extended definitions of employee under the super guarantee legislation. For example, contractors engaged wholly or principally for their labor. It will also include payments to directors, payments to entertainers, artists, musicians, sports persons, etc. For high income earning employees, qualifying earnings will include payments up to the maximum contribution base. Let's look into maximum contribution base. This is an upper limit of the employee's earnings on which employers are required to pay superannuation guarantee contributions. From an employee's earnings, once the employee's earnings reach this limit, the employee is not obliged to make further super guarantee contributions. Under the current system, the maximum contribution base is quarterly amount. So employers are required to pay super guarantee contributions on earnings up to the quarterly amount, which is kept every quarter. Any earnings above the quarterly cap do not attract compulsory super guarantee contributions. Under the Payday Super system, the maximum contribution cap will be 250,000 and will move from quarterly to an annual calculation. This means that employers will only need to pay super guarantee contributions on the first 250,000 of qualifying earnings for the entire financial year. So this is to ensure that the employee doesn't go over the 30,000 concessional contribution cap. For example, if an employee is earning 500,000, their super will be paid out in the first 2 quarters of the year. So employers will need to consider cash flow impact of this change. Employers will need to make sure that their payroll systems configurations has been updated. Also, please carefully consider transitional provisions. We will go through a more detailed example later in this session, as we have received a few questions on this point. There is a known risk that due to the timing of contributions on transition, some high-income earning employees may inadvertently receive excess concessional contributions. Also, employers should consider potential cash flow implications if, for example, they have a high-income earner who's been paid out their super contributions in full, and this person resigns partway through the year and is replaced by another high-income earner who is required to be paid super guarantee contribution up to their maximum contribution cap. This may lead to payments above 100% of budget for the role for the year. Employees in this situation may look into applying for super guarantee shortfall exemption certificates to avoid excess contributions. More information in this area should be released in the new year. Employers in such circumstances may wish to consider developing communication with affected employees to alert them and explain the change. Let's talk about super guarantee charge. So, super guarantee charge is essentially a penalty that may arise if employer fails to make the required super contribution in full or on time to the correct super fund. Super guarantee charge will be revised under Payday Super rules, with some changes being favorable and others not. First favorable change is that super guarantee charge and late super contributions will become tax deductible for employers. They're currently not tax deductible under the existing rules. Currently, super guarantee charge can arise on a quarterly basis. This will change under the Payday Super rules. The assessment of frequency will be based on each qualifying earnings day, QE day, so each payday, essentially. The charge will have essentially 4 components. First component will be individual final super guarantee shortfall. This component will be based on super guarantee rate of 12% and will be applied to QE or qualifying earnings for that payday. So basically the same way you would calculate super contributions. There will be no need to work out shortfall based on total salary and wages as it is necessary under the current rules. This is another positive, favorable change. A second component is notional earnings component or interest. It will arise to compensate employees for lost investment earnings. Notional earnings component will change from a flat 10% interest to a general interest calculation, general interest charge calculation on daily compounding basis, which may result in high amounts of interest. Another important change is that under the current rules, interest accrues from the first day of each affected quarter, regardless when the payment of earnings was made in that quarter. Under the new system, interest will accrue from the actual payday. This change is also favorable. Administrative uplift amount will replace the current fixed $20 fee per employee per quarter. The amount of administrative uplift may be variable and could be up to 60% of the shortfall amount. The purpose of administrative uplift is to reimburse the ATO for the cost of administration and enforcement. In some circumstances, the administrative uplift can be remitted, but there will be instances where administrative uplift amount will be much higher than the previous $20 per employee per quarter. And the last component is a choice loading. It can arise if employer failed to provide employees with fund choice options. Another important change in this area is there will be change in new ordering rules for late payments. Currently, there is a choice available how to apply the late payment offset. It can be applied to the affected quarter or can be carried forward as a prepayment for another quarter within 12 months. Under the Payday Super rules, if there is a shortfall for QE day 1, the next super guarantee contribution made is automatically applied to QE day 1, even if when it was paid, it was intended to apply to QE day 2. We will talk more about this later in the session, as we've received a few questions on this point as well. In the event when the tax office issues super guarantee assessment to the employer and the charge is not paid within the specified period, there will be general interest charged and late payment penalties applicable. ATO may have limited or no discretion to remit these penalties. So, as I mentioned before, super guarantee charge and late super guarantee contribution will become deductible, but general interest charge and late payment penalties will not be deductible. Our team currently does a lot of work in the areas of super guarantee compliance to assist employers to rectify underpayment or late payment of super and prepare super guarantee charge statements to be lodged with the ATO. To assist us with this work, we have an internally developed software which we call Super Guarantee Charge Analyzer or SGC Analyzer. This software automates the calculation of super guarantee charge and allows us to perform these projects quickly and efficiently for our clients. We have also commenced working on the new version of the software with updated rules for Payday Super. Let's move on to voluntary disclosures and ATO assessments. So under the Payday Super reforms, the compliance framework for missed and late super payments will change significantly. Currently, employers who have late or underpaid super payment must lodge super guarantee charge statements with the ATO. From 1st of July 2026, the requirement to lodge super guarantee charge statement is replaced by a voluntary disclosure regime. Employers can lodge voluntary disclosure statement before the ATO issues an assessment for a missed payday. Benefits of voluntary disclosure include the following. It can reduce or eliminate administrative uplift amount and demonstrate proactive compliance, which may influence penalty remission. ATO will be able to make assessments of super guarantee charge based on employer voluntary disclosure or based on their own ATO's initiative. For example, if ATO data matching programs identified late payment or discrepancies. So how will ATO identify those discrepancies? Let's have a look at interaction with single touch payroll or STP reporting. So STP reporting will expand to include new data points. Employers will have to include both qualifying earnings and super contributions for each pay cycle in STP reports to the ATO. Super funds are also required to report to the ATO the amount of super contributions they receive. This information will increase ATO's ability to data match reported super guarantee liability with actual contributions received by the super fund. With all this information available, the ATO would be able to detect late payments, underpayments, and discrepancies quickly and trigger compliance actions earlier, reducing the window for employers to self-correct errors. This means that payroll accuracy and timely reporting is critical. Businesses should ensure that single-touch payroll reporting is configured correctly in relation to items which should be part of QE or qualifying earnings. Look out for items such as salary sacrifice into super, which should be classified as part of QE, but salary sacrifice into fringe benefits should be set up to reduce QE amounts. In some instances, businesses are required to pay additional amounts of super under their enterprise bargaining agreements or industrial awards. These amounts are in addition to super guarantee and may need to be excluded from amounts of super reported to the ATO. One more area for employers to be aware of is in relation to payments to deemed employees or contractors. Often contractors are paid outside of payroll, so those payments are not required to be reported via STP, but superannuation paid to contractors when they're deemed employees is part of qualifying earnings and is required to be reported. Now, moving on to ATO's compliance approach. The ATO announced that they will adopt a new compliance model for Payday Super. The ATO has recently released practical compliance guidance, which sets out the approach for the first year of operation of Payday Super. The practical compliance guidance explains how the ATO will allocate compliance resources, and it essentially talks about risk-based approach, where employers will be categorized into low, medium, and high risk categories. So essentially, if employer makes genuine effort to comply and promptly corrects errors, ATO is advising that there'll be no compliance resources allocated to this category of employees because they'll be classified as low risk. Medium risk employers are those who partially comply and have some late payments. these employers will still have lower priority for the ATO. Higher risk employers are those who fail to make sufficient contributions or repeatedly breach obligations. This category of employers will be given higher priority by the ATO. Now, in summary, what employers should do to get ready for change? What I would like to stress is that this change is not a kind of change which businesses can start thinking about at the end of June and implement from 1st of July. I will strongly encourage to start preparing for this change as soon as possible. First, I would suggest to review your pay code configuration in relation to ordinary time earnings. The new QE concept will be based on ordinary time earnings. If you currently have issues or incorrect classifications in your payroll system, it's possible that you can carry them forward into the Payday Super environment, which will be more time sensitive, intense, and will have greater exposure to the ATO scrutiny. We have been helping clients with these health checks using our SGC analyzer, and this software allows us to quickly and efficiently identify errors in relation to payments of super grantee. If in your internal reviews you do identify any discrepancies with super payment, it is advisable to fix these issues without any delay. Also, when you will be reviewing your payroll systems in due course in relation to configurations for qualified earnings, use this opportunity to double check everything and get rid of all redundant pay codes. We strongly suggest not to recycle or reuse the redundant pay codes, particularly when the treatment for super is different. Next key area for businesses to consider is the payment frequency of payroll, and if there is any scope or ability to reduce the frequency. For example, to move from weekly to fortnightly or from fortnightly to monthly payroll. We get a lot of questions in this space. This is in itself is a complex process which will take time and will require some planning. Businesses operating under EBAs or awards will need to consider if there are any constraints for them based on the industrial relations agreements. Some EBAs and awards mandate specific pay cycle frequency. Also, it's important to consider employee agreements and also cash flow implications for the business to determine how the business will breach a payment gap. The businesses would need to carefully plan the transition and ensure that issues such as, for example, fringe benefit tax are carefully considered, as depending how the payroll frequency transition is done, it may give rise to a loan fringe benefit. Other important aspects include communication with employees. So let your employees know of the changes. The next area is to review governance and processes in paying super guarantee contributions. Make sure you understand the transitional rules and cash flow implications for the business. And lastly, please consider your current processes in relation to payments to superable contractors, particularly where contractors are paid via accounts payable. How will payroll be notified? Which contractors are required to be paid super, as super will have to be paid at the same time as payment to contractors is being made? Will payroll have the relevant super fund details for those contractors? Also note that if contractor payment is subject to GST, typically super would be calculated on GST exclusive amounts. As you can see, this change will require businesses to have streamlined, efficient processes and system automation where possible. Some of our clients have commented that they will use this as an opportunity to improve their systems. The Payday Super will require preparation. There is a limited number of pay runs left between now and 1st of July 2026. So use this pay run pay runs as practice runs and note down any issues which may affect streamlined payment of super under Payday Super environment. On this note, I will pass it on to Nigel to discuss the changes to the payroll system requirement and implementation of Payday Super.
Thank you, Elena. I'm going to look at the Payday Super changes from a different perspective, that of processing and system impacts, that should really be front of mind for payroll teams and other stakeholder groups, including HR and finance. I'll also be considering the changes that are going to impact payroll providers, clearinghouses, and super funds, as I understand them, but I strongly recommend that you all reach out to your respective payroll provider, clearinghouse, and default super fund to confirm how are they preparing for these changes. From a processing perspective, I'll talk about the sort of things you need to be reviewing with your current business as usual processes in the context of the Payday Super changes that we've heard of so far from Elena. I'll also be talking about some of the new processes that you'll need to incorporate into your procedures and working practices. So let's start at the beginning with employee lifecycle and look at the onboarding process. You'll need to assess how the choice forms for both new employees and changes to existing employees are currently managed and processed. What are the associated timelines? And is there any existing pain points or delays in getting this information to payroll? Is this data part of an existing integration between your HRIS and your payroll systems? Both new choice forms and changes of choice come within the 20-day remittance exception mentioned by Elena earlier. For payroll teams, you'll need to review your existing end-to-end standard operating procedures and cut-off times and adjust them to ensure that you do remit super payments on the qualifying earnings day, which we more commonly call in or refer to in payroll as payday. Ensure you have sufficient payroll team members across the new processes to cover for absences initially. Consider if any of your existing manual processes would impact your ability to comply with these new payday changes. For those of you that are already remitting super payments for each of your pay runs, you may still need to bring forward the payment process to the qualifying earnings date. Example, you may be remitting your super 2 days after the payday currently, with the new 7-day compliance best practice would be to send super funds on the actual payday. Please note there's nothing stopping you from moving to remitting payments for each of your pay runs between now and 1st July 2026. As Elena mentioned, you can start to think about transitioning now. You might consider transitioning in order to manage cash flow limitations, and I'll talk about that more coming up. If the task of remitting super payments currently sits with accounts payable, you may need to consider how and who is best placed to manage this process moving forward to comply with the new shorter timelines. You should also consider whether you will need to change your current approval and sign-off practices that you may have in place before you remit a super payment. You should also consider contractors entitled to superannuation, whether paid through payroll or accounts payable. As Elena mentioned, their superannuation contributions still need to be reported through single touch payroll and are thus included in the payday changes. This is an existing requirement, not a new one. Remember, the date of payment is going to be monitored from your single touch payroll reporting to the ATO, so they will know when you remit these payments. Finance teams should also be thinking about the implications on cash flow for these changes, not just in transitioning from quarterly to payday payments, but also the implications of paying over super contributions for annual payments such as bonuses, and also the impact of moving from quarterly to annual caps for higher earners. Moving on to super funds, rejected contributions. This is an issue that many payroll teams face today, where super funds cannot or don't allocate funds correctly, often referred to as bounce backs. which we know, which will now need to be resolved in a much more timelier manner by all parties involved in that process. The process is, however, being streamlined with simplified error messaging and how to fix guidance issued by the ATO. To reduce the occurrence of bounce backs, there's a new service being introduced to allow you to check super choice forms. The new member verification service provides an opportunity to verify an employee's super choice fund details with their chosen super fund before any payments are remitted. This is obviously a new process that you'll need to incorporate into your onboarding of change of super choice processing, but would hopefully significantly reduce future bounce backs. Finally, for out-of-cycle payments, you will have to until the next full payroll payday to remit these super contributions. In other words, you are not expected to remit super on the same day for each and every out-of-cycle payment that you make. So let's move on to consider the technology and system impacts. I'll start with payroll, noting that I've already mentioned earlier that considering how your employees' super choice information is collected and where this data is systemized as a single source of truth is an important consideration. There are several potential impacts on your payroll system configuration, some of which your payroll provider will already be working on to provide updates to align their functionality with the new requirements. I recommend that you keep a lookout for communication from your payroll vendors on their plans to incorporate the changes and their timelines for deployment of these changes. This extends to your outsourced payroll provider and thinking about who is currently responsible for remitting super payments. This can vary based on your service level agreement with them. My experience is that some of you will have asked your outsourced payroll provider to remit your super payments on your behalf, whilst others will have chosen to do this themselves as part of the payroll process. Either way, the obligation to meet the new rules lies with you, so check with your provider what changes are needed to ensure the process complies with the payday changes. For some of you, change from ordinary time earnings to qualifying earnings may have no impact at all, but for others, this may require changes as explained earlier by Elena. As she mentioned, this may also be the appropriate time to review your current pay codes assigned currently to ordinary time earnings, on which your payroll system will calculate superannuation contributions. Check how super salary sacrifice is processed or will be processed in the future in your payroll and will be included in qualifying earnings. Check that your configuration aligns with supervision set out in your awards and enterprise agreements. And consider deactivating pay codes no longer used as a maintenance task and refrain from repurposing old codes. We know that single-touch payroll reporting will need to be upgraded by all payroll providers to include additional reporting of both qualifying earnings and super contributions. And this will be used by the ATO to match corresponding reporting from super funds. So your payments will be matched by what the super funds tell the ATO you have sent. Changes in application of contribution gaps from quarterly to manual will likely require a change to your current payroll configuration. The ATO has also prescribed that you must use new payment technology to remit your super contributions to clearinghouses. For example, if you're currently making direct debit payments, you'll no longer be able to do so. Clearinghouses will also need to make changes to support much larger volumes and faster payments. And again, I recommend keeping a lookout for communications from your clearinghouse on what they are doing to accommodate the changes and their timelines. And also confirm if there are any changes to the service level agreement that you will have with them. It is worth reiterating at this point that if you are currently using the Small Business Superannuation Clearinghouse, this will be closed from the 1st of July 2026. You will need to move to a new clearinghouse. I suggest you think about transitioning to a new provider well in advance of this closure date. If you're a super fund you're going to be impacted with these changes as well, and you'll need to manage larger volumes of payment and allocations, report to the ATO or super funds paid to them, and adjust the significantly shorter timelines to allocate or reject funds. They'll need to comply with the streamlined rejected contribution messaging and guidance and implement the new member verification service that I referred to earlier. So let me finish off with a checklist of the next steps for you to think about. So in summary, consult with your HR team to review existing processes for onboarding and super choice changes. Review payroll team current processing and resourcing to accommodate timely processing of the Payday Super payments and managing of rejected transactions. Consult with your accounts payable to assess processes and approval timelines for remitting Payday Super contributions more regularly, and the potential impact that may have on your cash flow. Engage with your payroll vendor to understand functionality and timeframes for releasing product updates that you will need to test and arrange to deploy. Engage with your clearinghouse to understand changes they are making and how that might impact you, and equally with your default super fund to understand changes that they are planning to make. Elena did address the question of changing pay frequency in response to these changes. This is a complex question with many processing system and employee-related considerations. I highly recommend you seek special advice before embarking on this change. To close out, I urge you to act early and consider practice runs to surface issues with systems and processes now, so that you have time to resolve them before and be prepared for the 1st of July 2026. With that, I'll pass over to Ali to facilitate question and answers. Thank you.
We have a little bit of time now to answer your questions submitted through the registration process prior to the webinar. And actually, we've received some questions in the Q&A box today, so thank you for that. Any questions we don't get to, we'll try and respond over email following the webinar. But in the meantime, I see all our panelists have joined us. I might throw the first question over to Peejade. We've heard that Payday Super will cause cash flow challenges for small and medium-sized businesses, particularly those that would pay superannuation every quarter. What is your view on the impact of this transition?
Good afternoon, everyone. Certainly, there is no doubt that the transition to Payday Super will present some cash flow challenges for small and medium-sized businesses. This is even though that under the current regime, small and medium-sized businesses tend to try and do the right thing. So it's creating an additional burden on them. The key message is that businesses need to review the priorities of their payments to external parties. I think we're at a point now where superannuation contributions and salary and wages are two of the most important payments that you must make. It's almost non-negotiable from an employer's perspective. While salaries and wages, a non-payment of salaries and wages will give rise to, say, reputational risk for as employers, superannuation contributions is a little bit more problematic for employers, especially when the tax office is quite active in pursuing unpaid superannuation, and I'm quite willing to use the directors' penalties notices to recoup these payments. So when you get issued with these notices, if left unaddressed, could result in directors being personally liable to the payment of these super. And in extreme cases, the ATO might actually push for business to be placed in administrations or liquidations. So in that sense, I think there are a couple of things I think the businesses should look to do. First of all, is to start paying super on a more regular basis just to manage the cash flow, as both Elena and Nigel have explained previously. Any current payment plans that you have with the tax office, I think it's prudent for you to clear that, just in case that you may have some difficulties in paying super on temporary basis. And lastly, just reviewing your sources of funding and having that flexibility to pay the super contributions and the salaries and wages when needs arise. So I think that in short, I think the transition to Payday Super will have a far-reaching effect for a lot of small and medium enterprises. Back to you, Ali.
Thanks, Peejade. And it's always scary to note when liquidators are involved, and even under the current regime, we've had instances where director penalty notices have been issued directly against directors of companies, even where the companies themselves are unable to pay or meet their super obligations. So I think it's more of the same moving forward. The second question, Gary, I might throw to you. What is the ATO doing in relation to the education enforcement of the new provisions?
Yeah, thanks very much, Ali, and good afternoon, everyone. Well, just in relation to this space, firstly, I'll just clarify that there's no amnesty before introduction, so don't think that that's a possibility. There will be no soft launch and no phasing in of provisions, regardless of the size of the business. So none of that, unlike STP, had somewhat of a soft launch, but that's not the case with Payday Super. Now, as far as the ATO's education side of things, you may be familiar, but their website has been posting a number of fact sheets, videos, and other bits of information, as well as things like the practical compliance guideline that Elena mentioned before. We're also, and they'll continue posting those as they decide on certain policies and just other decisions that are relevant. Also, the things like, I'll mention out-of-cycle payments later on. The Commissioner has to make determinations in relation to those, as an example, and we expect that they will post those in the next few months on their website, so you become aware of those. But I'll talk about that a little bit later. Now, just retouching on the practical compliance guideline, that's only a draft guideline at this stage. There may be changes, so we can't anticipate whether or not that would be the case. The best way to not have a risk profile is, of course, to not have shortfalls in your super payments. So I think right at the outset, it's important that you get things like your payroll coding correct so that there's no potential for that.
And thanks, Gary. I know you mentioned the PCG there, the draft PCG. One of the things I heard a Deputy Commissioner from the ATO speaking recently about the changes and how they're looking to enforce the new rules against employers, and that I've spoken about in terms of the low risk. If they see that an employer is one day late and trying to do the right thing, they're like, we're not after. It's not the gotcha game. We're not after them. But I'm just a bit wary of those kind of comments, particularly with the type of environment seeing from the ATO at the moment, and all things, not just superannuation, reasonably aggressive. But thanks, Gary. Peejade, we've had a few questions on the maximum contribution base, so I might throw this one over to you. Elena mentioned that high-income earners may inadvertently find themselves liable to excess contribution tax. Can you please give us an example of how this could happen? And in addition, what are some of the potential traps that could affect these employees?
Sure, Ali. So I think the most common scenario that we're expecting to see in the transition to Payday Super is when you have contributions that are paid they're in relation to the last quarter of 25-26 income year, so April to June quarter, but that contribution is not being paid until July 2026 when Payday Super is being fully implemented. Now, for context, if you can remember, in terms of concessional contribution caps for employees is capped at $30,000. And the super contributions they're not recognized until they've been allocated and received by the employees' super fund accounts. So we can see a scenario where you may have paid the amount that's in relation to the June 2026 quarter, but if your payroll system has not been set up to handle that transition, or the processes have not been set up to handle that transition to the new regime, you could find yourself having because of the pay codes that's driving the payment, whereby you have 12 monthly payments that will plus that 13th payment, so to speak, that relates to the prior year, together as a sum that will get you over the threshold. Now, in that case, it's very hard to track, and the prevailing sentiment at the moment is that employees tend not to check their super balances, less the contributions that are going into the balance account. So it is quite likely that these employees, if they haven't actively monitored those contributions, they'll get a bit of an unwelcome surprise late June 2027. I think the other scenario that we can see is that, again, it relates to high income earners, and Eleanor has mentioned about the super guarantees exemption certificates. Now, those certificates have been slightly tweaked in a way that to allow for employees who change jobs partway through the year to apply for that so that the employee contributions do not have to apply in order to avoid breaching that $30,000 concessional contribution cap. But there's a slight level of complication here, whereby, let's say an employee has been working for one employer, they've received $25,000, or the employer has contributed $25,000 into their super fund accounts. Then they left for a new employer, but then it is the employee's responsibility to monitor whether that remaining $5,000 cap has been exhausted, and then therefore apply for the certificate to be approved by the tax office. While it is a little bit of a moot point because the excess contribution tax will be imposed on the top marginal tax rate. But from an employee's perspective, one, you have to have a mindset shift in terms of checking your balances. Two, applying that certificate. And three, thinking about having that cash in your hand or remaining in the fund in order to pay for that excess contribution tax. So there's a little bit to think about for the high income earners there. Ali?
Yeah, thanks, Peejade. Look, it sounds like it's going to get a little bit messy for employees, particularly higher earning employees that reach that cap.
Absolutely.
Gary, what happens if we make a payment in July 2026 that relates to the April-June 2026 quarter? So it relates to the previous regime. And we must also make payments for qualifying earnings in July. So how is that payment in July 2026 treated and allocated?
Yes, thanks, Ali. That's a good question. Certainly, I think a lot of you will have issues in this area. There's actually transitional provisions in the legislation that will deal with the overlap effectively of the old system and the new Payday Super regime. Now, I'll just briefly summarise how it will apply. Firstly, if you make a payment from 1 July up until 28th of July, and let's say you only pay your super quarterly and you've decided to still make the payment for the April to June quarter in July, up to July 28th. Now, under the transitional provisions, any payment you make up till 28th of July will automatically be applied against the April to June quarter's OTE, ordinary time earnings. Now, if there's no shortfall there, then if there's any excess, that'll then be applied to qualifying earnings from 1 July onwards. But the first thing to note is any payment up to 28th of July is always going to be firstly applied to that April-June quarter, and then only if there's no shortfall left, it'll be then applied from 1 July to qualifying earnings under the new regime. If you make any payments after the 28th of July, even if the intention was to apply that to the April to June quarter, it will only be applied to qualifying earnings from 1 July. So it'll only be used to address any payments issues from that date on. And what normally happens with qualifying earnings is they are always allocated to the earliest day in which there's a shortfall from 1 July onwards. And then if there's no shortfall, then they are then applied to the next qualifying earnings day and so on. So they always address in arrears any shortfalls. And if there's any excess right up until the qualifying day, then that will be moved forward to the next qualifying day. Now, it's important to note that if you do have a shortfall in the April to June quarter, and let's say you haven't paid by 28th of July, you need to make the payment. You need to advise the ATO. You can't just make the payment through the system directly. You would have to pay the ATO. Otherwise, it will only apply to the 1 July onwards periods. Okay, thanks, Ali. That's pretty much all I've got to say on that. But it is a confusing area initially, but hopefully some of the literature that will come out on this will clarify how it applies.
Yeah, thanks, Gary, and thanks, Peejade, as well. Look, we're coming to time. We're coming to 1 p.m. now, so thanks everybody for your questions and your time today. Keep an eye out for an email in the coming days where we'll be sharing a recording of this webinar along with the slides from our presentation. As always, should you have any questions or wish to discuss today's session any further, please reach out to any one of us or your usual Pitcher Partners contact. I was hoping we'd run through a few more questions. We've got many more questions that we haven't resolved for you all. What I will do, or what we will all do, we'll get back to everyone via email with the specific questions that they've raised. So thank you very much for your participation and your time today. Please do not hesitate to reach out to us for any support you might need in the near future. Thanks all.